is co-opted member of the Committee on International Tax of ICAI for the year 2016-17. He is a speaker at IFA Asia Africa Conference held in Mauritius in the year 2012, 14, and 16. He is invited as a panelist at Asia Pacific Regional Tax Conference 2016 held in Seoul, South Korea. Co-opted member of Committee on International Tax at ICAI for the year 18-19. Elected Vice Chairman of IFA India Branch 21 to 23. Sir, dais is all yours.
Rajam, a member of the managing committee of the Hyderabad branch of the Institute, my good friend, past chairman, Pankaj Trivedi, and other friends, ladies and gentlemen. I was just talking to my friend Pankaj, having a cup of tea, whether there is any interest still left in knowing the provisions of the Finance Bill 2023. But of course, always devil is in the detail. The more you start reading, the more trouble you are in. So anyhow, there are some hidden provisions which we need to really analyze and see where we stand today. And always that is the custom we have at the branch since I was chairman, and then it was taken over by Ajay Gandhi. And I have to really remember my good friend Ajay Gandhi, who has created that, the right atmosphere for real study circle meetings at that point of time, and the real academic nourishment we used to have. And on various issues in the study circle, we used to have animated discussions and all that. And I should admit at this point of time, when he was chairman, the first budget lecture I started giving, that was in 1999. He is the one who said, Prasad, you have to deliver lecture on the provisions of the finance bill that year. 99, 98, I was chairman. I can never forget Ajay Gandhi, and here we're very unfortunate to lose such a very beloved friend. So with that, be that as it may, and the provisions what are there, we need to discuss and get along and see where we stand today. So it has been claimed as Amrit Kal and Azadi Ka Amrit Mahotsav, and there are 7 important milestones, or you call the pillars, on which in the budget is presented by the Honorable Finance Minister, like Saptarshi of the Amrit Kal. It is like inclusive development, reaching the last mile, infrastructure and investment, and unleashing the potential, green growth, youth power, and financial sector. Friends, anyhow, the euphoria of budget is always there. It starts 15 days or a month before the budget is presented in the parliament. We have a long wish list always. Every sector will come up with their own long wish list being presented to the government as a pre-budget memoranda. But it is literally not possible for any finance minister to meet all the demands of different cross sections of the society. Of course, we all know how we have traveled to the COVID period, and now how economies are suffering and really struggling to get over in the best part of Europe. And also for the first time, US is, in the recent past, US is also facing the inflation and all that. So in this, India is definitely rated by the world economists, not by the economists in this country, as a bright star surging forward in the global arena. That is an undisputed fact. So in this backdrop, how you balance your priorities, how you put up the budget in such a manner. This is the last comprehensive budget, full-length budget for this term of the parliament. And everyone was expecting that there would be so many populist schemes and all that, but nothing of that sort. And a big hand, green signal for the capex expenditure, which is increased by more than 1/3 of what it was last year. And definitely the infra related allocation will always improve the other sectors, and we will have an overall improvement in the employment and other things. And as it is, if I am not wrong, we are at some 3.3 trillion or little more than 3 trillion, or that's what I'm given to understand. And whether it is definitely would be a possible achievement to hit 5 trillion economy in the near future. We don't know when that would be. The other day, Vikram was predicting 2027 should be the year by which we should reach 5 trillion, or it could be earlier also, we don't know. But anyhow, we are a very strong digital economy today. I think we are rated as third in the world in the digitalization, and which has given tremendous growth for some companies in this COVID period, as you know. As I always tell that the Indians are the most innovative brains who knows how to live in best of the times and worst of the times. So that way, we now definitely stand apart as a unique economy now in this present economic global economic scenario. So in this backdrop, let us get into the provisions proper and see what are proposed in this finance bill, against which there could be some representation definitely being made by the institutions like our ICAI and other chambers of commerce, where there is some sort of unintended consequences that may flow from the proposals. So let us get quickly into this, which is the most talked about provision, that is 115 BAC, the new regime versus the old regime. It is not confined only to individuals and HUF, but extended to association of persons, body of individuals, and artificial judicial person. So the new regime now becomes the default regime. But of course, I am very poor at uploading any return, which I didn't do for the last 10, 12 years, not to boast myself or to claim that I am doing something good, because my team helps me completing the whole thing. I always keep postponing and I never know how it's being uploaded and all that. But now I am told that once you start doing it, you will be in the new regime, would be the default regime. So you would be taken into the new regime unless you opt for the old regime. So what is now being offered in the new regime of taxation, personal taxation, and also the HUF taxation? What are the provisions? What are the amendments that are proposed to make it more attractive? And in the years to come, the government would like to have the new regime becomes the only regime probably. So a different slab system is provided with only 5 slabs, starting with the minimum threshold of 3 lakhs. And you know, each slab is of 3 lakhs, then 3 to 6 with 5%, 6 to 9 with 10%, 9 to 12 with 15%, and 12 to 15 with 20%, and above 15 lakhs at 30%. So this is available only to the new regime taxpayers and not to the old regime. Old regime continues to be at 2.5 lakhs as the basic threshold. With this, there is one more, what are the other deductions a taxpayer in the new regime can claim? 80 CCD dealing with the National Pension Scheme, which is already there even in the existing law. 80 CCH is a new provision which is brought into the statute book this year, dealing with the Agnipath scheme. As you all know, last year we had a lot of discussion about recruitment into Indian Army in a different manner, giving out only a 4-year appointment for the youngsters to work in the army, which has attracted a lot of criticism from the opposition and all the stakeholders in the society. They had their own views of point. And but be that as it may, it has become effective. And as per that scheme, the Agniveer Corpus Fund would be floated. A person who gets recruited into this, under this scheme into the army is called Agniveer. And whatever he contributes is being allowed as a deduction under 80 CCH, which we will deal in detail when we go a little forward. That is a deduction over and above. See, the whole approach of the new regime is to avoid providing any deductions and exemptions. But some deductions are still going on. Among these deductions, 80 CCH is also there. 80 JJAA is with respect to employees deduction, which is provided to promote employment, which continues to be available for a taxpayer in the new regime. 80 LA1A is with reference to some sort of interest income earned from offshore banking units located in International Financial Services Center in the Gift City in Gujarat. So these 4 deductions are also available to a taxpayer being covered by new regime. Over and above this, alternate minimum tax, which is a replica of what you say, the MAT, what we have for the corporates. AMT has come into statute book some time back, which covers individuals and other status SSEs. For the alternate minimum tax, that would not be applicable. And 115 JC is the alternate minimum tax and 115 JD is the tax credit, corresponding tax credit. Those provisions are not applicable. And you have the tax rebate being increased to 25,000 under 87A. 87A, which hitherto was helping you, make you with nil tax at 5 lakh income, will take you to 7 lakhs. Up to 7 lakhs, you would not be paying any tax. That is available only under the new regime. And also that standard deduction, which was not there here in this regime, is brought here, and that 50,000 rupees is available. So with this, the basic calculation, I'm not going into calculations. We have so many combinations and all that. For want of time, we can't go into that. And so up to 7 lakhs, 50,000, probably you can take a view that you will have nil tax. And the Revenue Secretary goes on record and to say that 50% of the taxpayers are likely to shift to, that is their fond hope. Let us see what happens and how taxpayers are going to take to this new scheme. As I understand from some of the tables given in Business Line the other day, up to 35 lakh income, probably both are on the same footing. Till such time, I think the old regime is favorable. But if you cross 35 lakh, probably at the 50 lakh level, is it so? I think the new regime. Acha.
Basically depends on how much benefits you'll be taking under chapter.
Okay.
4 lakhs 25,000 is the
okay. Okay. So that's the reason I told you will have to work out on so many combinations, not just one combination, and see. And then around 1 crore taxpayers will be under this regime is the fond hope. And one good thing with this regime is you will be left with more cash surplus with you, which will again pep up the economy. Instead of saving, probably you will be putting into so many items of expenditure, whether productive or not, definitely it will go into the economy. And the fond hope is the gap between the two regimes is going to be narrowed down in a significant manner. And the surcharge, which is really bothering the high net worth individuals, is going to be slashed down at the highest level 37% to 25%, which will make the overall tax rate in the hands of a high net worth individual to be brought down to 39% from 42.7 or something. So that is a welcome move, because there has been a lot of representation that the tax rate, what a high net worth individual is paying, is much beyond the foreign companies' rate also. And nowhere in the world such rate is prevailing, except a few economies again. So there is a lot of representation. I think some redressal has happened here. And then coming to the leave encashment, what I'm able to understand, that is with respect to non-government salaried employees, the basic tax-free exemption limit of 3 lakhs at the time of retirement, leave encashment has gone to 25 lakhs. This is a very liberal move, and that is what it is. And then quickly we will come to Section 9 amendment. This is 918B. See, it is always the non-resident taxation is driven by deeming fiction under Section 9 in our country. 9 is the most comprehensive legislation what we have, deciding what is deemed to accrue or arise in the hands of a non-resident. In fact, we had a lot of amendments coming with respect to resident and not ordinary residents from last 2 years back. We had a lot of, because now all the taxpayers, especially the high net worth taxpayers, have become so mobile. They are planning their affairs in such a manner, they maintain their residential status in a different country and operate their businesses in this country. So that is all the background what we had 2 years back with reference to RNVAR. We will not go into that for want of time, but be that as it may, in that any gift received by a resident but not an ordinary resident. Who is a resident but a not ordinary resident? Who is a non-resident for 9 continuous years outside, who has come back for good? He will be a resident and not ordinary resident for 2 years. During such period, his income, what is earned in India, alone would be taxed, and not the income what is earned outside, out of the investments what he made when he was non-resident, would not be brought to tax. So somehow they thought RNVARs are receiving gifts from Indian residents which are outside the tax ambit, because it would be deemed as an income received outside India. That is the interpretation probably being taken. There is already a provision in the law. If at all a non-resident receives a gift, that is already brought into tax. They would like to add RNVAR also to that group, so that whatever he receives as a gift from an Indian is deemed to have been received in India and to be treated as a taxable item. And coming quickly to Section 10, we have some, tinkering happened with reference to some non-deliverable, deliverable forward contracts and all that. That I'm not going to spend more time. 80 LEA 1A is with reference to the International Financial Services Center. And 1022B is with reference to news agency, which is there for a long time in the Congress rule long back, that income earned by the news agency is exempt, and somehow this government thought that has to be repealed now. Of course, there is always a broad approach that the exemptions have to be pruned down, have to be slashed down, and ultimately all these exemptions have to go. And new clause 12C in the said section, so as to provide that any payment from the Agniveer Corpus Fund, that is what I mentioned, Agnipath scheme, under the Agnipath scheme to a person enrolled under the said scheme or to his nominee shall be exempted. Any payment made from that fund is an exempt item. It is further proposed to give reference to the definitions of the Agniveer Corpus Fund and Agnipath scheme. That is all governed by the provisions of the ordinance released in November 2022 when the scheme became operational. And then, and in an approach to prune down or the exemption provisions, all these have gone and no more operational from 2024-25 assessment year, dealing with the Northeastern Development Finance Corporation Limited, Credit Guarantee Fund. All these things have been withdrawn and they are not going to be in the statute book. Then coming to 1046, I have to spend little time here because a very important development happened in the month of October when the Honorable Supreme Court delivered a judgment in the case of Ahmedabad Urban Development Authority. Reported in, of course, Tax Sutra, ITR, every law journal has reported it. It's a 150-page judgment delivered by the bench comprising of the Chief Justice Lalit and Justice Ravindra Bhatt and one more judge. I don't remember the name. 3-judge bench has delivered a judgment on the general public utility concept, what is discussed in the definition of charitable institution or activity in 215 of the Act. There is a very lengthy discussion. In fact, battery of lawyers have argued this matter right from Harish Salve, Arvind Attar, and our good friend KK Chaitanya from Bangalore also argued. Battery of lawyers argued the matters, representing different cases, all batched together and heard by the Supreme Court bench. So there is always the broad allegation or the broad dispute is in the activity of a charitable institution, whether the commercial angle needs to be examined in detail. If at all it is found to be pursuing a commercial approach by collecting fees, cess, conducting classes, conducting courses, all that, to that extent, the exemption what is available, be it be under 1023C or the 12AB regime now, is it to be now the past is 12AA or whatever it is it to be restricted? All this is before the Supreme Court. As you all know, Surat Silk's case way back, the dominant purpose was the guiding factor. If at all the dominant purpose of the trust or the institution is pursuing objects of charity, then any incidental commercial activity cannot contaminate the status or claim of the institution to be exempt, so as to be exempt for the taxes. But this is discussed threadbare by the Honorable Supreme Court, which you need to study that judgment. They have discussed at length and said, when it comes to provision 215, 215 talks about education and healthcare and the other important, I think there is one more dimension to charitable 215, I will just read out, because this is the far-reaching implication. Charitable purpose includes relief of the poor, education, of course they have included yoga, medical relief, preservation of environment, very important. Now the climate protection is very important, and preservation of monuments or places or objects of artistic or historic interest and the advancement of any other object of general public utility. Any advancement of any other object of general public utility is very important. When you talk about the original 4 or 5 items like relief of the poor, education and medical relief, yoga and all that, you are on a safe footing. There is no question of analyzing what could be the commercial angle in that, because the commercial angle is discussed in the proviso, provided that the advancement of any other object of general public utility shall not be a charitable purpose if it involves the carrying on of any activity in the nature of trade, commerce or business, or any activity of rendering any service in relation to any trade, commerce or business for a cess or fee or any other consideration, irrespective of the nature of use or application or retention of the income from such activity, unless such activity is undertaken in the course of the actual carrying out of such advancement of any other object of general public utility, and aggregate receipts from such activity or activities during the previous year do not exceed 20% of the total receipts. So there are two exceptions that are given in the same proviso, which says if at all the commercial activity is intertwined with the pursuing of the main objects of the institution, which you must be able to demonstrate, then it would not be treated as a commercial activity. And the other thing is, even if you carry out a commercial activity, the surplus of which you are going to utilize for the object, even such reasoning will not help you getting bailed out from this. Only the exception is if the receipts are not more than 20%. Then it would not be considered as a commercial activity. If at all the receipts are more than that, then you are in danger. That is where the discussion before the Honorable Supreme Court is so instructive today. In fact, Harish Salve argued on behalf of the BCCI, which is the richest sports body in the country. Invariably, BCCI is doing only commercial activity, nothing more than that. And because Harish Salve, who is a #1 lawyer, a CA turned lawyer, who appeared before the Honorable Supreme Court heard all his arguments and said, let it be re-examined again by the tax authorities. Institute of Chartered Accountants is represented by Arvind Datar, an eminent lawyer from Chennai. He represents, because even ICA is one of the appellants. And ICA's entire mechanism, how it functions and all that has been examined at length. And the Honorable Court has all praise for the institute's activity. And then, but they cautioned at the end, institute seems to have been amassing surpluses of various activities, which can be a danger signal, which can create a problem for the tax exempt status. That is what they have warned. And coming to the housing boards, housing boards or the town planning boards or such boards set up by state or central legislations are 100% meant only for social development or the cause of the upliftment of, if it is house for the housing cause, if for promotion of the housing activity for the benefit of the poor and all that. So in such cases, you cannot infer that there is a commercial activity dimension. Though they sell, they issue tickets, or they do anything, whatever that fee and other things what they have mentioned, whatever nomenclature they use in carrying out their activity, that cannot in no way contaminate the activity of these boards. That is called statutory corporations, legislated either under a state law or under the central law. So to that extent, they are safe. There is no problem. So to separate that particular segment from this 1046, a new provision is being inserted, 1046A, to cover such statutory corporations pursuing the housing activity, rural development activity, or the town planning activity and other things. Such boards would be out of the radar of this ratio of the new judgment. That is for that purpose, they have set up 1046A, and they said these corporations would be governed by the new provision. They are totally out from that old provision of 1046. Whatever that is left out in 1046 is susceptible for a detailed scrutiny and examination. This is what you need to bear in mind as far as Ahmedabad Urban Development Authority's ratio is concerned, which has far-reaching consequence with respect to every institution which you want to claim to be tax exempt either under 12AB regime or under 1023C. Then quickly coming to 10AA SEZs, never ever there is any provision to lay down what is the time limit before which you have to bring back the export proceeds in foreign exchange. We already have the guidance coming from the Foreign Exchange Management Act, where the export proceeds have to come back within 12 months broadly. In some cases, there is RBI is competent to extend that. And if you have activities going on outside the country, you are entitled to open an export earners foreign currency account, and you can maintain the receipts in that account which are deemed to have been received in this country. So be that as it may, though we have a we have a time limit under the FEMA regulations. Now they thought it is appropriate to bring an explicit provision stating that it must be brought within within a prescribed time limit into the country. They have put it as 6 months from the end of the financial year, or such time as extended by the competent authority, which is the Reserve Bank of India. If at all you do not get the the foreign exchange or the export proceeds within such time, to that extent your assessment can be rectified. A consequential amendment is also made. And then quickly coming to the charitable trusts. In fact, in charitable trusts, I would not claim that I have covered the entire gamut of the amendment. I would take you definitely through the most important dimensions. There could be some areas where there could be further fine-tuning of debate, that is, further debate is required. But I would definitely take you through the most important changes that are proposed. So in the first place, the memorandum carries, I think, 6 pages of description about these proposed changes to the regime of charitable institutions, be it under the 12AB regime or the 1023C regime. Broadly, you need to bear in mind, there is gone were the days when you can start one society, do the activity, don't report anything for years to come, and after 6, 7, 8 years you come for a registration. That has been done away with long back, because I myself got some trusts registered 20 years back who started their activity much before, say 7, 8 years back. When we were able to demonstrate their activity, we were granted 12-year registration that time, even for the period, that is the past period starting from the date of inception. But you can never dream of such thing now. That is all done away with. You are under an obligation to go for provisional registration if the activity of the institution or a trust is yet to start. But you have set up the trust or institution and you have to commence your objects, you have to commence your activity, then you should necessarily go for a provisional registration. Once you start the activity, the provisional registration must be converted into a regular registration. Even the regular registration, what is the life? It is only 5 years. It is not for eternity. In fact, there were situations where we fought cases before the tribunal and also before the court stating that the exemption status or registration granted under 12A cannot be revoked. All those days have gone, and they have come out with amended law stating that an officer who has granted the registration has a power to revoke that. So much water has flown under the bridge. So these 2 registrations, you must be extremely careful and ensure that you meet the deadline dates properly, failing which you will have most undesirable consequences. And then quickly looking at some of the provisions, some of the amendments they have proposed. In case of voluntary contributions made with specific directions to form part of the corpus would be treated as application if amount is invested, deposited within 5 years in the mode specified in 11.5 and no violation under section 40A 1A, 40A 3, 3A, and not for benefit person. That is most important. Persons who are notified under 13.3, that the persons who run the trust and all that, they should not get any sort of advantage or benefit. If these things are happening, these are the additional conditions which are roped in. That is one thing. And repayment in case of application made from any loan or borrowing. We all know that if at all you are applying for the objects from the borrowed funds, you will not be, that would not be treated as application in that year, but would be treated as application when you are repaying the loan. The repayment cannot happen after 20 years now. They said 5 years time, that's all. If you are repaying within 5 years, we will consider that as an application. Otherwise, we will not consider. Because they are amending the provisions in such a manner, they must have the utmost comfort and ease to kill the institutions. And I would use that word because there is no leeway given anywhere. You commit the smallest mistake, the price would be very heavy. That is the approach being pursued, as I understand. These provisions would not be applicable where application is made from the corpus on or before 31/3/2021. In fact, as you know, from corpus also you apply, you must pay it back to the corpus again, because corpus fund is not supposed to be used for application. Application should come from the regular surplus, not from the corpus. Corpus or loan, you must give it back. So for their ease, whatever you have done before 31/3/21, whether it is a loan borrowed or from corpus, those things are not going to be considered in the new regime. The proposed provision is you must, that 5-year period, what you need to bear in mind. And one more thing is the inter-trust donations is restricted to 85%. The reasoning that is taken in the memorandum explaining the provisions is, of course, the tax planning, even we all have fertile minds creating a lot of tax planning. Multiple trusts are created where what is happening, you are donating from X trust to Y trust. Y will donate it to Z. Z will donate it to A. Like that, what is happening when it is ultimately applied? Rupees has been applied. That is what is the proposal. And there is a statement that they want to be filed by these trusts 2 months in advance. I mean, where the income has been accumulated or set apart for application to such purposes, the same has to be now intimated to the assessing officer by filing a statement at least 2 months prior to the due date of filing the return of income under section 139. That is the form 9A in 10, correct. And then exemption under 11 and 12 is available to the institution registered under 12A, now it is 12AB, if ROI is filed within the due date. See, the within the due date has become so critical now. You used to have this type of provision for the deductions under 80 IA, I mean deductions under 10AA and all that. Now even for the charitable institutions, there is no way you can go beyond the time limit permitted for filing the return. And specified violations shall now include the application referred to for registration to the principal commissioner or the commissioner, where you have provided false or incorrect information would tantamount to a specified violation. So these are the restrictions that have been additionally brought. And the most important amendment is 115TD. That is with reference to accreted income, tax on accreted income. If at all you are a trust transiting from 12A regime to 12AB, that is what I could understand from the reading, there is a deadline date of 31/3/21 for which they have extended time up to 22 March, if I'm not wrong, 31st March 2022. Some condonation of delay is given up to some November or something by a circular. If at all you are a trust who has decided not to go and take the exemption and you want to be a taxable institution in future, and you are not transited into the new exemption regime, then they are all visited with a shocking surprise in this budget, in this proposal. they are going to take the accretion with respect to the surplus, what they have, net surplus, what they have, and levy a tax. And let us broadly understand what is the move. Then you can go into detail and read it. This would really be upsetting the apple cart because they have been complying with the law till 31/3/21 and availed the exemption status. Just because they have not continued their exemption status, which is not a compulsion under the law, they have opted out because the restrictions have become so many and it is very difficult to comply with the law now. They thought whatever is the surplus, we will pay tax and be done with it. See, there are many schools, to my knowledge, who are not registered as societies. They are functioning as taxable units, but they are registered with the Ministry of Education in center also. But they are paying taxes. So the same way, if at all you opt to go out of this exemption regime, now it has become counterproductive for them with this retrospective amendment, which they are making it retrospective from 23/24. What it says, the net surplus what you had at the time you have surrendered your exemption status would be charged with an exit tax, which is totally against the principles of natural justice. And if you go into the Honorable Supreme Court's judgment in Vatica Township, any benefit or an advantage provided to a taxpayer cannot be taken away retrospectively. You can do anything prospectively. You do anything. You are known for doing it. You can do that. The moment there is a judgment in favor of the SSC, you will undo that, neutralize the judgment by bringing an amendment, but do it prospectively, not retrospectively. If you go to the faceless assessment, 133(9), if I am not wrong, not 133(9), 144 A9 or something, 144 A9 or B9. There it says the procedure, if it is not followed meticulously, the entire proceeding should crumble. They will become honest. That is the bedrock of the faceless assessment, which has been removed last year, which has been withdrawn, just to facilitate their officers' mistakes and wrongdoing. You do any mistake, proceedings must be alive. You must be able to collect the taxes. You must be able to proceed with your assessment and all that. So that is like hitting at the bedrock of the very concept of faceless assessment, which can be challenged with the ratio of what is laid down by the Honorable Supreme Court in Vatica Township. The same concept would apply even here. See, just because I have taken an option to go out of the exemption regime and became a taxable SSE, I am ready to pay taxes for the future, not for the past. Past, I have satisfied you and have claimed my exemption status, which is approved by you. If you are charging tax on the surplus, what does it mean? You are charging the past. You are taxing the past. So this is one very, very undesirable consequence under 115 TD, because it's very difficult to remember these alphabets as told by Devadas, because that 26 alphabets would be used in so many combinations. So this is one thing you have to bear it in mind. And they would say that if at all your registration gets cancelled because you are not meeting the deadline date obligations, like applying for the regular registration on time and all that, then that can result in cancellation of the registration and also slapping the trustees with the exit tax. So they have tightened so much the entire assessment mechanism of these institutions, you just can't understand. In fact, Kamlesh Varshni is a senior IRS officer. He is of the rank Chief Commissioner, whom I personally know because he is very active in the International Fiscal Association also. But in the budget, whenever we invite, this time also we invited him in Delhi, they will always say that whatever we are doing is 100% correct, because they are supposed to do. If you are a revenue officer, you will also say the same thing, whatever we are proposing, it is 100% right. Because when I think this entire tightening process started from 2020, if I'm not wrong, or 2020, in the same COVID year, that equalization levy 2.0 has come, and they started tightening the entire assessment process of charitable institutions. See, you should not go beyond a particular level of flexibility. If you go beyond that, then you are undoing the entire thing. That we must remember. If there are any dark horses, you must be able to catch them. You must be able to punish them. It is not that you punish the entire taxpayers of the said group. That is what it is. And the exit tax chairman Nitin Gupta, CBDT chairman, justifies that why can't we charge the exit tax when it is being charged for companies? It can come even for the institutions. That is what it is. And then we will go to, this is the case law impacted KPMG Foundation and all that. This you can go through, where that inter-trust donations and all that, which has been undone because of a amendment stating that only 85% would be allowed as, would be treated as applied. Coming quickly to 28.4, which deals with a perquisite, a benefit or a perquisite received by an SSE, a business SSE who is into business or profession. As you know, 28.4 is under fire from last 2 years. You know that in the last year's budget, we have an amendment proposing to tax the medical practitioners who receive freebies from the pharma companies. There is a medical council circular which prohibits any medical practitioner to receive any, any sort of benefits or freebies from the pharma companies. Because it is against the provisions of such circular, which regulates the medical profession, the lawmakers took a view that it is against the public policy, and an explanation was added to section 37, whereby they have added other dimensions also. Whatever violations you incur, whatever violations you commit, with respect to the foreign law also, if you are operating outside, would come under the scanner of 37 explanation. You know, the explanation to 37 was added way back some 20-25 years on account of the Pranav construction decision of the Mumbai tribunal, where extortion money was paid by a real estate businessman to this gundas and all that in Mumbai, which was allowed as a incidental expenditure, which was claimed as incidental expenditure by the SSE, which was disputed by the AO, and it has gone to the tribunal, and tribunal allowed it. Immediately explanation was brought to section 37, stating that any expenditure you incur against the public policy is not to be allowed. That we all know. And to that they have brought in this also, any freebies and all that against the code of conduct of that particular profession, then it should not be allowed. So thereby there is a controversy, because if you go to 28.4 and see the wording, it talks about in kind. And there is always an argument that if at all the benefit is received in kind, like getting a travel ticket, free travel ticket and all that, then only it would be treated as a perquisite. If I receive something in cash, some waiver of loan is not to be treated as 28.4. Like that, there are arguments and there are judgments in favor of the SSE. Now it is clarified that 28.4 covers cash or kind, both partly in cash or partly in kind. And a corresponding amendment has been made to 194R. 194R has come into the statute book only to obligate a person who is providing that benefit to the SSE, the business SSE or a professional, to deduct 10% tax. 194A is widely debated across the country last year because of the guidance given by the CBDT, which is very, very impractical. So this Mahindra and Mahindra's decision of the Supreme Court, where it was held that the benefit, the perquisite or benefit should be non-cash has been neutralized by bringing or changing the wording stating that though you receive the benefit in cash or in kind, both are covered as perquisites. And then 35D talks about the preliminary expenses, amortization of preliminary expenditure, where earlier, if you go into 35D, which is a very long provision, you have a restriction stating that if at all you take a feasibility report or a project report, which you are treating it as a preliminary expenditure, either incurred before commencement of the activity or incurred after commencing the original activity and you are under the expansion process, it should have been incurred only again with such concerns who are notified. That means only such concerns must do a service of providing the feasibility report or appraisal report for the concerned project. Then only you will be allowed to amortize that expenditure as a preliminary expenditure over a period of 10 years. Now that requirement of going through that, notified service providers has been done away with. You can take service from anyone. You will have to just bring it in the form of a particular format. You file it with the assessing officer, which they claim it as a measure towards ease of doing business. And then 43B, MSME, any payments you are supposed to make to MSME are brought under the radar of 43B, and they are allowed only on the payment basis and governed by the due date of the respective legislation. That is section 15, which says the maximum period is 45 days. So it goes by the payment basis, and that explanation which says if you make the payment before the due date for filing the return is not available for this particular expenditure. So you have to necessarily make it before the due date as per MSME Act. If at all that due date is falling beyond 31st March of the financial year, then it can be claimed only in the next year and not this year. That is what you need to bear it in mind. And 43D, this is only some SS. Yes.
So you mean to say the invoice is dated 15th March, 45 days to 30th April.
Yes. Yes.
And if I don't pay before 31st March, it will go to next year.
And there is an explanation. There is an explanation. If at all you are able to prove that you have paid as per the MSME Act. Suppose let us say that MSME Act you have time up to 30th April. Let us say that would come in this year. If you are paying beyond 30th April, then it will go into next year. That is what is to be. Because that is falling within the allowed time under the section 50. Then coming to for next one is this is regarding NBFCs. Yes. 43D, this is regarding NBFCs, which is not, that is regarding bad debts being claimed by the financial institutions. That we can skip. Then the most important thing, playing to the gallery. (44AD), 44ADA. So much of tinkering happens here to push you to the non-cash approach, either in terms of receipts or in terms of expenditure. If you just go into 44AD, let us say, we all know traditionally 8%. I'm just taking you through the most important facets of this with corresponding provisions in 44AB. 44AD is the presumptive tax for originally for retail traders. All that has gone. When we were doing 44AD, that was retail trader and all that has gone. Now it is 8%. What is the threshold you have? Now it is 2 crores. If at all you are going under the presumptive scheme and offer 8%, it is 2 crores. Please don't forget, if at all you are able to demonstrate that entire gross receipts are 100% through banking channels, you have 6%. Don't forget that that is there in 44AD. After that, if you go to 44AB, and if at all you are not offering income as per the presumptive rate, and if you are offering lesser than that, you will have to necessarily go through the tax audit. There was one proviso in 44AB till now, which is getting repealed now, which says if you are both receipts and expenditure or through banking channels at 95% level or more, then the threshold limit for tax audit is 10 crore. But that has gone now. That proviso is being substituted with a new proviso. That you please bear it in mind. Please go to the finance bill and carefully see that proviso has gone. I will show how it is. You go to the act. (44) first proviso says in the act, provided that in the case of a person whose aggregate of all amounts received, including amount received for sales, turnover or gross receipts during the previous year in cash does not exceed 5% of the said amount, and aggregate of all payments made, including amount incurred for expenditure in cash during the previous year does not exceed 5% of the said payment. This clause shall have effect as if for words 1 crore rupees, the words 10 crore rupees have been substituted. When it has come, this has come by the Finance Act 2020. This is the first proviso to 44ABA. Then go to the bill. (44AB) says in section 44AB, for the first proviso, following proviso shall be substituted with effect from first day of April 2024, namely. Do you have the bill with you, all of you? What does it say? Shall be substituted. That means the first proviso will go and this will come. So the 10 crore has been taken away. Am I right? Or is there any different view? So that is the only amendment in 44AB. Provided that this section shall not apply to a person who declares profits and gains for the previous year in accordance with the provisions of subsection 1 of 44AD or subsection 1 of 44ADA. What is that? We'll examine. So the very first proviso which talks about 10 crore limit has been substituted with this new proviso. It is not adding a new proviso, it is substitution of the old proviso that will go and this will remain. When you come to 44AD, it says 5%, it should be less than 5% of the total turnover or gross receipts, cash receipts, then you have 3 crore limit. If you are able to comply and satisfy the 95% benchmark through banking channels for the receipts, you will get 3 crore. Then for the professionals, that 50 lakhs has been increased to 75 lakhs. See, generally professionals, there is a lot of cash component. Which cash component must be reduced now? It should be only through banking channels. Then you will have 75 lakhs, that 50% offering and all. There is one more, addition made. If you receive any bearer check other than account pay check, it is to be treated as cash. Then how do you monitor that? I don't know. How do you monitor that? No, is there a mechanism which can tell that you have got 50% of your checks are bearer checks? I don't know. And I am told by Karimnagar people, I was talking to Karimnagar who are more intelligent than all of us. They told, sir, there is a mechanism at the bank level. Banks, because the first lecture, this time I had it in Karimnagar because a good friend DK Anand has been requesting me from last 2 years, the taxpayer secretary there. This year I could not, he told me this time when I went to Mr. Purnachandra Rao's daughter's wedding, he said, nothing doing, you are promising me now today, you have to come there. Then I said, okay. Then I have to go there. And then they said, no, sir, we have a record of bearer checks and account pay checks, banks will have. Then that will help the tax department to immediately get the, you are telling you have so much of turnover, how much has come through account pay and how much has come through bearer will be known. If it is bearer, you are in trouble, it is as good as cash. That you must remember. That is very important. And digital payments is covered, online payments are covered. What do you mean by digital payment? Google Pay is also linked to the bank account only, no? See, that is coming from one bank account to the other bank account. See, one of my bank accounts I am attaching to my app. You will attach one of your bank accounts. It's a bank to bank only. Google app is only facilitating transfer without going to the bank and doing it. You need not have to do enough transactions, go there and do it. That is not required. Huh? Not cash, not cash. Be happy about it for some time. Pardon? Cross DD, and you are going to purchase the DD. That is what bankers purchasing. That is, what they have not done, don't alert them. They will bring it under the scanner. You do it calmly, that's all. See, if you are buying, if you are asking your banker to purchase, why DD the same day it is getting credited, no? Banker's check will get credited the same day now. With this, now there is no requirement, not like olden days where you used to purchase DDs, all that has gone. See, within no time it will get credited. Why should you? So that is not there. Yes, yes.
Here there was some saying that the receipts are less than 5%, cash receipts are less than 5%. So if payments are also less, expenses are also less than 5%.
That's what I told now, 10 crore. That has gone. That has gone.
So that's how payments.
No, the payments, they are not restricting you now. Payments you can do as you want, but receipts must be under control. Then you have this 3 crore limit for 44 AD and 75 lakhs for a professional. That expenditure now they have removed because the 10 crore they have removed that.
So now what is the
Revised? Yeah, 1 crore is the general limit continue. Yes, 1 crore is the general limit. If you have this 44 AD, you have 3 crores. If you are satisfying that 95% receipts through banking channels, up to 3 crore, you are not liable for tax audit. If you are a professional, 75 lakhs. Yes, yes. Because I want to spend more time on this provision. Pardon? Yes, yes. (44 AB). No, you go to 44 AB. What is the existing provision you see? There only there is an amendment to substitute that proviso. Yeah. No. 44 AB. No. Where you are reading, which provision you are dealing? A, B, tax audit. And what is the proviso? You have the first proviso. Immediately after A, 44 AB, A. After A, you have the proviso. Yes. Now, can you show it to me in this book? Because don't go by that mobile. This is the first proviso. This is the latest Act 22. This is the first proviso.
This is first proviso to clause A,
Here.
but 44AB's first proviso comes here, provided that this section should not apply to the person who has property or taken the previous year.
Then how can that be treated as the first proviso? See, the proviso starts from here.
Right, but this is inside this clause. This is a proviso to clause A.
Where it is mentioned that this proviso is going to substitute.
In the section 44AB, for the first proviso, so that it's not referring as first proviso to clause
How
A.
can you treat this as the first proviso? No, no.
Not talking about first proviso to clause A. Generally, any provision has to happen with the first proviso to clause A.
Now, according to me, you are rightly referred to this proviso. This proviso is going to continue. This is not removed.
This is not an application.
Yes, that's what.
Application.
Yes. Yes,
It
it's
is only referring to additional 44ADA has been added here. Earlier it was not added.
No, this cannot be treated as a. Anyhow, Miro, you just see the text. Yes, yes. Yes, yes, please. But what you talk must be audible. You want to see? No, what it says?
Who is a trading, original trading, and substitute provision says that this 44AB shall not be applicable to person who declared income in section 44AD as well as 44ADA. So I think
No, but I agree.
yes.
There is one valid reason what my friend says. There was reference only to 44AD earlier. Now the reference is both to 44AD and ADA.
Yes, sir.
When there is a reference to both 44AD and ADA in this new proviso, it would correlate with similar proviso sitting in the statute. That is what he means to say. But unfortunately, if you look at the number, that is not the first proviso. That can never be treated as a first proviso. No, if you are talking the number, that is wrong. If they are going to clarify nothing like that, we'll all be happy that 10 crore would be, but this is one possible interpretation because there are no subsections here. In 44AB, there is no subsections. 44AB says A and then you go to B, C. In A itself, you have a proviso. No, where is that mentioned? In the act, in the bill, it should be mentioned, no? In the bill, see, proviso is there to A, one more proviso is there to other clause.
So one more clarification, sir.
Yes.
If you see the original section, after clause A, it has been mentioned. The first proviso is what provided that, and the second proviso is provided further.
Yes.
And if you go down, and again it starts with provided again. So I guess the first two provisions are for only for clause A.
Pardon?
So can I come?
And a proviso is only for the first proviso?
I guess so, because the first two provisions of the section says that provided and provided further.
Yes.
Can I come there and explain you?
Yes,
sir?
yes. Because that's the debate we want to have today. Otherwise, there is no meaning to clause by clause. That's what I told. No, the views can be multiple. Yes. Yes.
So here you can see that the first provision to clause 44 maybe clause A provided, and then again it is provided further. And again after all the sections, the next start is provided. So I think this is the first provision to the entire.
No, provided further again.
No, it is again provided. So I think this is the first provision to the entire section.
I definitely give points to the reference of 44 AD only there. And whereas the new proviso is talking of 44 AD as well as ADA. So his point is That is what I discussed with my team also. When you have already referred AD there is one more proviso continuing exclusively for AD is meaningless. So definitely if this is going to substitute that proviso, we are all happy that 10 crore thing is intact. So let us hope so. Then in that case, we will have to, the chambers have to really get the clarification and the institute also has to get a clarification. You cannot take a view that the proviso should be treated as proviso starting there. No, I don't agree to that, because provided further is used, proviso, the first proviso is also there. So we cannot take a view that third proviso has to be taken as the first proviso. No. No, that they have to mention. No, they didn't mention that. So in 44AB, what they mentioned, in section 44AB, for the first proviso, the following proviso shall be substituted. First proviso to clause A or clause B, then it would have been more clear. No, there is one more thinking. We'll have to see what is mentioned in the memorandum explaining the provisions. You'll have to see what is put in the memorandum explaining the provisions also. We have to see. Can you tell me in which page it is there? 20? 23. You are talking? 2-3. That is section 9.
No, sir.
Memorandum explaining only, I'm saying.
Yeah. 6 point. 6th point, sir.
Please open here, sir. Because I have downloaded this. Yes, that's fine. So that is increasing threshold limits for presumptive income taxation. There only has talked about 44AB also. Under section 44AB of the Act, every person carrying on business is required to get his accounts audited if his total sales, turnover or gross receipts in business exceeds 1 crore rupees in any previous. The limit is raised to 10 crore where at least 95% of the receipts are in non-cash amount. In case of a person carrying on profession, he is required to get his accounts audited if his gross receipts in profession exceed 50 lakh. Those opting for and fulfilling the conditions laid in the presumptive scheme are exempt from audit under this section. Representations have been received for increasing the threshold for eligibility for availing benefits of the presumptive schemes for eligible businesses and professions in order to benefit more persons. In order to ease compliance and to promote non-cash transactions, it is proposed to increase the threshold limits for presumptive scheme in section 44AD and 44ADA on fulfillment of certain conditions. Those conditions are only talking about this 3 crores and 75 lakhs. See, when they talk about this 3 crore and 75 lakh, they should also mention that this 10 crore thing is being continued. And is it there? You just see. It is not there. Of course, anyhow, I'm not removing the doubt. Definitely, it needs to be clarified. If at all it is to be treated as a proviso, first proviso, if it substitutes the first proviso, we are a loser. If it is substituted, technically, that reasoning is correct because 44 AD reference is substituted with reference to AD and ADA. If that is technically correct and that is the intention of the amendment, then this 10 crore also would be protected. Then let us quickly go to 44 BB and 44 BBB. These are the two provisions. These are the presumptive income provisions for the non-residents. 44 BB talks about such a non-resident who is in business and providing services or leasing out plant and machinery to such businesses in India which are engaged in prospecting and exploration of mineral oils. Such non-resident who is providing services to support the mineral exploration activity, he is provided with a 10% presumptive rate of profit. But what is happening? These non-residents are maintaining books of account parallelly. Whenever there is a loss, they are opting out of 44 BB and declaring loss and coming back to 44 BB whenever their profit is more than 10%. And what they are doing, not only that, the carry forward losses are being adjusted against the presumptive income. 44 BBB is with reference to civil construction activity by foreign companies in providing for a turnkey power project. Such civil construction activity also there is a presumptive taxation of 10% there. So this approach is not correct. That is as per the government government thinking. And they said, if at all you are coming under the presumptive scheme, there is no way you can claim unabsorbed depreciation or losses against that presumptive income offered. And then 45(5)(a), we all know, this has come into the statute book to provide that capital gains taxation will only happen in the joint development agreements only in the year of completion of the project. A completion certificate given by the competent authority, let it be HUDA or HMD or whoever is the authority, only in that year, the individual or HUF is supposed to offer capital gains. We had a 20-25 year fight to get this provision in the statute book. We had plethora of judgments right from Chaturbhuj Dwarkadas case from Bombay High Court, which came in favor of the SSE. Again, the Andhra Pradesh High Court went against the SSE and ruled in that Putluri Nageshwar Rao's case, stating that the moment you enter the development agreement, it is liable for capital gains taxation and all that. So to relieve from that trigger, this amendment has come some 5 years. I think it from 2016. I think 16 onwards it is there. In this, there is a mention about cash component in 45(5)(a). And a landlord not only receives constructed area, but also cash must be aggregated for the purpose of computing the capital gains, obviously. When you go to 194 IC, 194 IC talks about TDS at the rate of 10% in respect of cash, bank or anything. Cash obviously means even check payments and bank transfers and all that. That should suffer 10% payment, 10% TDS. So there is a mismatch of the wording between the two provisions, which is being taken advantage by the SSCs, and they are trying to exclude non-cash. They are literally meaning what is cash. If you receive in cash, that is cash. If it is received through banking checks, it is not cash, which is not taken for the purpose of computation of capital gains, which is totally incorrect. So to set the aggressive approach at rest, it has been told that here also it means cash bank or any online transfer, everything must be considered for the purpose of computing the capital gains. Then you have this EGR, which we need not have to spend more time. This electronic gold receipts, instead of keeping gold idle at home, if you convert into electronic gold receipts, you will get some income. This conversion should not be treated as a transfer. And if at all the EGRs are being sold subsequently, the holding period in the form of gold is also considered, whether it is short term or long term, and vice versa. That is what is explained in this EGRs thing. And then we have the relocation of a fund again to the International Financial Services Center is not to be treated as transfer. And mode of computation of capital gains under section 48 here, whatever interest you pay on home loans to construct or buy a property, residential property, you can always claim it as an expenditure under section 24 against the rental income. There are cases where whatever interest you have paid on the home loans is also added to the cost of acquisition, which has been endorsed by the courts of law as the right approach to set it rest and take a view that one should not have a double benefit. Now it is clarified, once you claim it as an expenditure against the income, rental income, there is no way you can add it to the cost of acquisition for the purpose of section 48. These are the case law which got overruled, which was originally ruled in favor of the SSE, where they allowed double claim, which is not possible now. And some judgments went in favor of the revenue, which are now confirmed by the proposed amendment. Then market-linked debentures. What is market-linked debentures? It's a hybrid instrument. All these mutual funds, these are all targeted for high net worth individuals. What they do, it has a hybrid character. It is called a debenture. When it's a debenture, it is a debt. So they are assured of some sort of minimum return, but that return is not paid on an annual basis. It gets added up to the fund and is paid only at the end. And the return on that investment is linked to the market indices, like the equity what you have, because of which it attains the character of an equity also. So this hybrid instrument allows investors to enjoy only 10% tax because it is equated as an equity investment, and there you get the 10% tax. Now the amendment is brought in to treat this as a short-term capital asset, and the tax is levied accordingly. And then profit on sale of property used for residence 54 or 54F. Now the government is of the view that the reinvestment benefit should be restricted to 10 crore rupees, because high net worth individuals, even cities like Hyderabad, are now experiencing villas which are costing 20 crores, 30 crores. Sky is the limit, how the real estate is developing. And there are high net worth individuals who get huge gains from the stock market, and they invest the entire amount into luxury villas and all that, sky villas, luxury villas and all that. So now that is not the intention of the government. The intention of the government is to promote housing activity in such a manner that it is equally distributed across the country in respect of all the individuals. So that way there is a restriction of 10 crore now, keeping the inflation and all in mind. But even 10 crore is being looked at as a small figure, and there are some representations going stating that this 10 crore must be increased. But be that as it may, the proposal is that 10 crore is what maximum you can reinvest and claim the gains of 10 crore for 54, and the net consideration is what you have to invest under 54. So the net consideration should be obviously 10 crore. If it is more than that, it gets restricted to 10 crores. And then this intangible asset, the cost of acquisition being restricted to nil. There is a lot of debate on this among professionals, whether this would impact every intangible, because the word used in the amendment is intangible asset. Intangible asset can throw a lot of controversy, because even a software developed in a company is an intangible. Then there is a theory that is doing rounds. it is sitting alongside those rights and those items where the cost of acquisition is treated as nil, like self-generated goodwill. You have the tenancy rights. You have other rights for which you cannot determine what is the separate cost for them. When the cost is indeterminable, when the cost cannot be found out in a scientific manner, the computations provisions will fail. That is what B.C. Srinivas Setty's judgment way back by the Honorable Supreme Court. Much water has fallen under the bridge, and we have many items for which the cost of acquisition is to be deemed as nil. Now, intangible asset is sitting alongside such items. You will have to use one doctrine as per the interpretation of treaty, interpretation of statutes. You will have to apply the same meaning what goes with the other rights. That obviously means you should think of only those intangible assets for which the cost is indeterminable. For such intangible assets where cost is determined on the approved accounting approach, then you cannot bring that intangible asset and keep it here and say cost of acquisition is nil and I will share the entire consideration of sale as a taxable gain. So that is not the meaning. So we'll have to understand this intangible asset as such intangible asset which got developed in a comprehensive manner in the business for which the cost cannot be separately determined. Only such items will fall in the category and the cost of acquisition has to be treated as nil from the assessment year 24-25. And these are all the cases which got overruled. In all these cases, with respect to some particular intangible asset for which the cost is indeterminable, the courts have held the computation mechanism fails as per B.C. Srinivas Setty's case and it is not taxable. To neutralize these judgments and bring such intangibles to tax, this has been, even these judgments, the whole focus is on indeterminable cost of acquisition. Obviously, that is what is discussed even in the memorandum explaining the provisions. So intangible assets for which you can capture the cost cannot be covered by this amendment. And then business trust again, you have real estate investment trust. And now real estate investment trusts are in a big way. Again, high net worth individuals keep investing in that. And interest, rent and other items, they are getting taxed. Acha, this is, I will, one minute. I will discuss this provision also with one more slide so that it would be complete there. First, I will discuss this 5627B, then I will go to the business trust. There is one more slide. 5627B, what is 5627B? Can anyone explain what it is? Pardon? No, you take, no. What is 5627B? Who are mostly affected, you know that?
Sir, when a closely held company issues
7B. 5627. No.
when a closely held company issues shares or securities with a premium,
Yes.
then
To whom?
to its shareholders.
No, as per the law, it is to residents.
Okay. Then the excess amount of the market value is subject to the liable and the entity has to pay the tax on that.
Under the issuing company,
Yes, issuing
the
company.
investee company has to pay tax.
Exactly, sir.
Okay. Who are affected most? There is a lot of
Companies.
hue and cry. This is called angel tax. Startup companies are most affected because startup companies continue to incur losses for years together. And if you go by the NAV valuation, it is always zero or minus also. Flipkart, I don't know what is present position. Flipkart has been incurring losses till it received $16 billion from Walmart. Walmart has given the valuation at $16 billion and they have purchased Flipkart. Walmart are not fools to buy Flipkart with $16 billion when it is incurring losses. Because they value the technology the processes they have, the market reach they have. That is the reason they have invested so much of amount and purchased the company. So here the valuation is a very, very tricky matter. So when two unrelated parties come together in the market, they know how to value. Income tax officer need not tell what is the value. And the buyer is not a fool to invest $16 billion. What is 1 billion? I don't know the exact conversion into around 5,500 crores. That is the value for $1 billion. And they're not fools to buy Flipkart at $16 billion. I'm just giving a classic example, which all of us know, which Flipkart is developed by two IITians, Sachin Bansal and another Bansal. I don't know, two Bansals, both from IIT Delhi. Okay. 5627B is primarily targeted only for resident investors. Why resident investors? This provision is coming to the statute book in 2012. The then finance minister, Mr. Pranab Mukherjee, moved this amendment proposal in the finance bill 2012, where GAR was also moved, but GAR came into act only in 1819 with a lot of debate and other things. When 5627B, what is the purpose is to check the unaccounted money flowing into companies, unlisted companies with a huge premium. So you want to check the investor's background and try to tax them because they are investing that much. So they will tax investors also. In the first place, they are taxing the company. That is the purpose behind introducing 5627B. Now, the word resident is removed. Thereby, all non-residents, everyone gets covered. There is a hue and cry you would have seen in the papers. All angel investors, high net worth individuals who invest in these companies, startups, they are all making a huge representation. What for you are bringing this proposal? It's a meaningless proposal. Why? I will tell you. If at all a non-resident is investing into a startup, like Walmart, let us say, or Tata Group invests into many startups like that, the foreign investors also, SoftBank invests. And SoftBank is one of the leading venture capitalists. They invest. Of course, this 5627B doesn't cover venture capitalists. That you remember, there is an exception in that. Venture capitalists are not covered, but high net worth individuals are getting covered by this. Foreign companies are getting covered who are not a venture capitalist. So when they are investing money into this country, FDI regulations will take care. The FEMA has got its own regulations. FDI investments are welcome. And FDI, the FEMA regulations prescribe that you must get the appropriate value. RBI will always say you should not take value below the real value as per discounted cash flow method. What is discounted cash flow method? That will value the future of the company. On the future revenue projections, your value is decided, which is an accepted method of valuation as per FEMA regulations. As per 11U, the tax officer will try to bring the net asset value. Net asset value is always zero, but the startup companies are minus because no one is going to, there is no worth there. You can't look at the NAV. Because of looking at NAV, all startups are slapped with a lot of adjustment invoking 56.7B in 2018. And there is a lot of hue and cry, and the Ministry of Commerce, Department of Promotion of Industry and Internal Trade, part of Commerce Ministry, has brought out a circular on February 2019. There is a circular issued stating that DP startups registered with the Ministry of Commerce under DP IIT with set conditions being complied with, they are not hit by the angel tax. But of course, the conditions are, most of the conditions are impractical. They say the startups cannot set up subsidiaries outside. The startup cannot give advances, even advance to a salaried employee, because in startups, the HR cost is more critical. Suppose you are developing an app and all that. The software professionals have to be taken care, and you give a lot of incentives and advances. Such advances cannot be given. ESOP trust cannot be created. All these restrictions are there, by virtue of which most of the startups did not go under DPIIT. Because of which they have changed their headquarters to the other countries also. So this is the history what we have. This is the background what we have. Be that as it may, whoever got registered with DPIIT is exempt from the angel tax. They are also instructed, if at all you have done assessments, you should not fight it further, and then you should allow the SSC to have the exemption at the appellate level because of the circular and all that. So that is one side of the story, which we know till now. Now they want to bring even the non-resident investors and the foreign investors into this, which is totally a retrograde step. I wrote an article which is published in Tax Sutra on 5th or 6th, it was published, you can see. It's a totally retrograde step because the purpose for which you brought this amendment is not getting, has no relevance with this amendment. The residents are already covered and being taken care under 56(7)(b) who are getting assessed here. Why are you bothered about the source of non-resident who is ready to pay a huge premium? He is not a fool to pay a huge premium. He will pay a premium and take shares in an upcoming company. So you are going to question the source of the source can never be questioned. Daulat Ram Rawat Mills case, Supreme Court. You can never question the source of source. That too, when FDI is flowing into the country. So this is a total retrograde step against which you can see number of articles have come in all the business papers. They are making representation to the government. They must create some proposal for us to discuss like this. No, otherwise there is no meeting at all. Say they will create enough work for us, not only enough deliberation, and tomorrow there is no wonder even if it gets legislated also. And coming to the insurance policies, this is a very tricky provision on which I have to spend the maximum time. Business trust will come. Business trust will come later to this. There is one more slide, that time I will cover them. That reason is always there, that money laundering is there. Why are you bothered about it? Money laundering, PMLA is very powerful. Today, PMLA is only being pursued by the Enforcement Directorate. See, when it is coming from US, from a listed company, why you are bothered then? It's a ridiculous provision. See, non-resident, then you can never grow. From one side, you say we want to become 5 trillion economy, and the other side, you don't allow non-residents to invest. We have, they say, they proudly claim 90,000 startups are there today. They will suffer, all startups will suffer. I think they will take a right decision of dropping it. I think this is all the play of the bureaucracy. Bureaucracy will create havoc. Even the ministers, they do not know. Suddenly they will come and put it in the last minute. They have all the power to create havoc in the last minute. They will bring that provision, that's all. Don't think that finance minister knows all this. She doesn't know, because whatever ministers they put up, whatever secretaries they put up, she will have to go by that. Achha, now coming to this 1010D, now there is a proposal that if you have a policy for which the premium exceeds 5 lakhs, that is the wording, the maturity proceeds are going to be taxed from 24-25 assessment year. Then they have also used a wording, very typical wording they have used. So 1010D for the 6th proviso provided also that nothing contained in this clause shall apply with respect to any life insurance policy other than a unit linked insurance policy. ULIP already we have it from last 2 years, where 2.5 lakhs is the limit. issued on or after 1st day of April 2023, if the amount of the premium payable for any previous year during the term of such policy exceeds 5 lakh rupees, that is fine. It doesn't end there. One more provided also that if the premium is payable by a person for more than one life insurance policy other than unit-linked insurance policy, the provisions of this clause shall apply only with respect to those life insurance policies other than unit-linked insurance, where the aggregate amount of the premium does not exceed the amount referred to in the 6th proviso in any of the previous year during the term of any of these policies. We will have to break our heads to understand what this is, because the same wording you have even for the ULIPs also. For your information, because I am not so proficient as you all in examining this 1010D and the other provisions, I have invested the maximum time in knowing this. My team has really helped me. There is one article given by the Taxman Research Group, Taxman publication, when this ULIP proposal has come 2 years back. So I have given that in the form of an example for your easy understanding. The same example I have carried. I have not invented this. I have correlated this with 5 lakh policy. You have, as on 1/4/2023, you have an annual premium policy of 2 lakhs. From 1/4/2024, you have another 3 policies, 2 lakhs, 3 lakhs, 6 lakhs. Shall we take an interpretation that only 6 lakhs policy will be hit by 1010D amendment, thereby the proceeds would get taxed, and the all other 3 policies would sail through and they are not to be taxed when paid back? But that is not the correct interpretation. That would have been the most favorable interpretation, but not so, not correct as per the wording given there. So what you need to do, there is one restriction. What you have to bear it in mind is that 10%, the premium should not cross 10% of the capital sum issued. That is one condition you have to prove, we have to comply with. And then you just see, you have to aggregate these policies and see whether that minimum threshold is getting, like indirectly you have a threshold of 5 lakhs. Any of the 6 lakhs is being taxed, you keep it aside. In this, you take a 5 lakh threshold. Again, satisfying that 10% condition, that is premium should not be more than 10% of the capital sum issued. Then you can club 2 lakhs, 2 lakhs, 4, or 2 lakhs, 3 lakhs. You will always take the maximum. That is 2 and 3. That is what my team says. The exemption is restricted to consideration and LIC policy B, since aggregate of the premium payable for the LIC policies X and B together does not exceed 5 for any of the previous years during the term. Because if you go back, X is 2 lakhs, B is 3 lakhs. If I take X and A, it is only 4 lakhs. I am eligible up to 5. So that 5 I am exhausting here. 6 is anyhow taxable. So what happens then? This policy A will become taxable. As simple as that. And as difficult as that. Okay. Then this one says ULIP policies are also to be analyzed in the same manner. This is what the Taxman Research Group gives. But anyhow, even for these policies, the silver lining is, if at all the proceeds are received at the time of death of the policy holder, that is not to be taxed. Thank God. At least that event they are considering. And I will quickly run through from here. I think the most important things have been completed. And what is the disinvestment of with this we need not have to spend time. This is mainly designed to take care of IDBI Bank disinvestment as well as Air India. So benefits to the startups have been this 7-year period for losses increased to 10 years. What is in 79? You have a condition that 51% shareholding must be continued for you to claim the set off of losses. For startups, the relaxation is the original promoters must continue just like that, even with one share. They should not go out of the company, but they need not have 51% holding. That would automatically get diluted because the venture capitalists come into that and other investors come. If that condition is satisfied, the losses for the first 7 years is allowed to be carried forward, though it is not complying with the condition of 79, it would be allowed to be set off. That 7-year period has been extended to 10 years. And also, the incorporation date for the startup has been extended to year after year, they are extending. Now it is extended up to 31st March 2024. And why these funds have been removed from ATG, you can understand, I need not explain. These name-driven funds have been removed from the ATG application. 2025 trusts and institutions shall be allowed to make an application for provisional approval and then regular approval, which I have already discussed. ATCCH, I have discussed the Agnipath scheme, which started from 1st November 2022 on the basis of Indian Armed Forces introduced wide letter so-and-so, this is an ordinance, 29 December 2022 of Government of India in the Ministry of Defense. And then rebate reference to 88 is no more relevant because 87A is the rebate. So reference to 88, that old rebate, they have removed that reference in many provisions. And then 92D is with reference to the transfer pricing documentation. Transfer pricing documentation is supposed to be in the place by the time you file the tax return. But many a time we start preparing the documentation after receiving the notice from the TPO. You can be visited with a penalty on the very next day if you are not filing a documentation, but gracefully they are giving time because they also do not know what it is. So they have been giving time, but now they are becoming cleverer and cleverer year by year. They hear in the conferences and they apply against us. So what is happening that now many SSCs, they are taking time to develop documentation after receiving the notice, which is not the intention of the law. So earlier the time limit was 30 days. Either CIT appeals can call for the documentation or the TPO. The 30 days time has been reduced to 10 days. Within 10 days, you have to. That is the reason when you receive the first notice from the TPO, the first ingredient is definitely the transfer pricing documentation and so many other details they ask. What we do for our client, the moment the notice comes, immediately we will file the documentation. The other details can wait and he cannot penalize even if it is getting delayed. This is the first one we need to take care of. So gracefully they are giving 10 days time as against 30 days what was there in the statute. There is a confusion here. When you go to the bill, it says 10 days at both the places because earlier law was 30 days, which can be extended further by another 30 days. But when we here in the memorandum, they said 10 days can be extended to another 30 days. But when we come to the bill, it is saying 10 days at both the places. So let us be more conservative, treat that as only 10 days. And then 94B is interest limitation exercise, which you need to understand. When you have a company which is owned by a foreign company, you have a subsidiary here. That is the popular model in the software industry, where the parent company sits in US and you have a subsidiary in India, which is the software development center, because the HR cost is very competitive in India and the talented people you can get at a low cost, you get the software developed in India. That is the popular model, all of us we know. What they do, the parent company will invest only $10,000 as equity and $90,000 as debt. This is the most popular model across the globe. This is called thin capitalization. Why you invest in the form of debt? So that the interest against the debt will be a charge against the profits here. So the thin capitalization rule is a anti-avoidance rule as per BEPS Action Plan 4, base erosion and profit shifting, which has become a reality in the form of multilateral instrument from 2020. India is also a signatory, and we have ratified our all the DTAs. Most of the DTAs are now covered by the MLI because the other treaty partner also has to ratify. So this BEPS Action Plan says if you have excess interest restricted to 30%. That's all. Over and above that, it would be carried forward for 8 years to come as per 94B, which is a provision brought in line with the BEPS Action Plan 4, globally accepted. That means this is called interest limitation rule. In this, the exception is banks and insurance companies are not covered because they deal with the financial transactions. There you cannot put a restriction. And unfortunately, in this provision, I don't go into this for want of time. Even if you get a guarantee from an associated enterprise, that means your parent sitting outside gives a guarantee to a foreign bank, which foreign bank gives loan to you. Even that would get covered for the purpose of interest restriction. That is called either implicit guarantee or an explicit guarantee gets covered, which is a very harsh consequence, but that is the reality as per 94B. Be that as it may, we have exception for banking. That means if you are a banker in India, paying interest to another foreign bank who is your associated enterprise, there this restriction of 30% is not there. Same way for the insurance sector. In that, now this NBFC is also getting added. Such class of non-banking financial companies, as may be notified by the central government, will get added, and they would be out of the radar or the ambit of 94B. Then cooperative manufacturing, manufacturing cooperative societies are also going to enjoy the same 15% tax rate which is available to the manufacturing companies, provided you don't claim any deductions and pay tax only on 15%. While enacting this, they said if at all there is any income that is derived by the cooperative society, which is not derived out of the manufacturing activity, then it would be taxed at 22%. Last year, we had a provision wherein they have brought in the cooperative societies to 22% rate, on par with another 22% bracket we have for the companies. Manufacturing companies is a different category. Here also in the cooperative societies, if you are into manufacturing activity, you come and sit in this group. What is manufacturing? We have a whole host of case law, and what is manufacturing? We can go by that. And 115 BAE is with reference to corresponding effect has been given to BAD, tax on income in respect of resident excluding cooperative societies specified in one. That is all a consequential amendment. One more amendment which is important is when once you are sitting in a concessional tax regime, your transactions with other units or closely connected persons would be examined under the transfer pricing regulations. That is a specified domestic transaction rule what we have with reference to tax holiday unit and non-tax holiday unit of the same company. Pharma companies, you have SEZ units and non-SEZ units, where we comply with the SDT provisions, which have the similar provisions of international transactions. Same TP report, everything has to be prepared, and you have to comply with that. The same rule would apply here also, because the manufacturing cooperative society might have transactions with the other units which are covered by 22%. There is always a motivation to inflate profits in the manufacturing unit where you have a lesser rate of taxation, lower rate of taxation. And then taxation from winnings from online games is brought into, because that is the focus. Last year it is virtual digital asset. Now it is online games. Online games also, our youngsters are more into online games. They are earning or losing, everything is happening. Because they are also losing, that has been appreciated. And the net winnings at the end of the year would be taxed at 30%. Without any threshold of 10%, 10,000, which is available for TDS provisions for lotteries and crossword puzzles and all that. The 10,000 is not available. But this Internet Mobile Association had represented, because they want to bring some regulation for these online games, where they are negotiating as to what is the definition of an online game. That we will come to know very soon, and we will see what it is. And then now the provision is 30%, and the TDS provision also they will apply on the from the first rupee. Okay, then we have 132, there is nothing much here. There is, they can take the help of some officers while conducting the search. As we know, police officers' help can always be taken by the search authorities. I mean, authorities who are conducting a search under 132. Now they can take help of digital forensic professionals, valuers, archive experts and all that. And they can also take valuation from the valuation officers who are notified by the principal chief commissioner, who are approved by the principal chief commissioners in the whole process. 140B talks about the payment for an updated return. There is no big amendment here, except saying that when you compute the tax payable under 140B, as how you pay 140A tax for the regular return, self-assessment tax, 140B is for the updated return, which is to be filed under section 139(8)A. So while calculating the tax, you should remove only whatever advance tax you have paid, as simple as that. Don't get confused, because some wording was playing some mischief, that has been removed. You have to remove whatever advance tax you have paid, and then on that balance tax, you have to calculate 234B interest. And regarding the valuation of inventory, 142(2)A is the special audit. We know that. There they have brought in the amendment to provide that the inventory can be valued at the instance of the department by a cost accountant. Cost accountant will be given an assignment. But here, as I understand from the memorandum explaining the provision, they are going to bear the expenditure. Who is going to bear the expenditure? Government is going to bear the expenditure. They are not going to push the expenditure on the head of the SSE, as I understand. Because even with respect to the special audits, what I understand, because I'm not very familiar, now I think it is being borne by the department only. Earlier, if you remember, originally before 2007, it was borne by the SSE. They used to put, as how bankers push all the costs to the borrower. Even the government used to push even the special audit cost on the SSE. But 2007 onwards, they are bearing. They have a panel and they decide the fee structure periodically, and then they pay. Even this cost accountant's fee would be borne by the government. And the income escaping assessment, from the date you get a notice for filing the return in the reassessment proceeding, you will have only 3 months time. Once you cross that 3 months time, the return file is not to be treated as filed under section 139. If it is not under 139, you are at a great loss. You are at a great loss. Because there is one appeal which I have fought in the tribunal recently, that is in the 153A return regime, the search returns, whether you can claim a new tax deduction, like a tax holiday for a SEZ or infrastructure or anything, ATIA, in the return filed under 153A. You have Kabul Chawla's case, so many other cases of Delhi tribunal, where they say, unless there is an incriminating material, you cannot make an adjustment for the revenue officers. In the same way, a claim what you have not made in the original return, you cannot make it in the 153A return. But I have my own judgments coming from JSW Steel and all that from the Bombay Court, where they said, this is a return in line with the provisions of 139. And once it is 139, it's a clean slate and you can claim what all you can. On that basis, I have one a case before the Hyderabad bench of the tribunal when Godara was the judicial member, and he gave relief stating that JSW Bombay's High Court judgment is very much applicable here. So why I'm explaining that, because the return filed under 153A is covered, is treated as filed under 139. And once it is 139, you have a clean slate and you are going like a fresh return where you can make your own claims, though you didn't make that claim in the original return. So here also, you will lose that 139 return status if you are not filing within 3 months. Then you have some tinkering with reference to extended time. Suppose the search happens in the last 15 days of the financial year. The notice, if it is issued, it is deemed to have been issued on the last day, so that they have the advantage of some time limit and all that. That has been brought. And 148A, the competent authorities, the authorities who are notified to allow assessing officer to go beyond 3 years. When you will go beyond 3 years, when the escaped assets are valued more than 50 lakhs. For that, the competent tax authorities to approve that is Principal Chief Commissioner or Principal Director General or Chief Commissioner or Director General. Below that rank, they cannot authorize the assessing officer to go ahead with 10-year mechanism for the reassessment. And here, this 139 8-year return time limit for completion of the assessment, originally it is 9 months, that is now extended to 12 months. And even for the regular assessments, 9 months is proposed to be extended to 12 months. Pardon? Always, mostly that. Time limit for completion of assessment, reassessment, some 263, 264 authorities have been notified. That is not a problem. And here you need to see if at all where an assessment or reassessment is pending on the date of initiation of a search or 132A proceeding, then additional 12 months time is given. It is also facilitating their assessment mechanism. And then 155, this is, what is this 10AA? I mentioned about 10AA, you will have to get the export proceeds for SEZ within 6 months from the end of the year. If it is not received, so the tax officer has an authority under 155 11A to rectify your assessment and slap an adjustment. This is with reference to the sugar cooperative society is not required. And this is important, TDS mismatch, especially in the professional's hands also. We do the bank audit and we book it as only in the year in which you receive the remuneration or the fee. But whereas the banks will book the TDS expenditure for the 31st March. So there is a mismatch. That mismatch is going to be addressed now. You will always offer the income in the year in which you will offer the income as per your accounting methodology. If you are following the cash system of accounting, you will offer it only in the year in which you receive the check. So in the same year, now you are allowed to take the credit. So all through we have been, I think if I'm not wrong, we are taking it forward, the TDS credit and trying to take the adjustment or something like that. Now that mismatch can be avoided by moving an application before the assessing officer who is duty bound to rectify the assessment for that year in which you have offered the income and allow this credit there. And these are the case laws diluted. And 170A is with reference to amalgamation cases where a notice is issued in the amalgamating company and amalgamated company can respond to that and file the modified return. And then this 194B, the 10,000 threshold is removed for online games. It is available and continues in the case of lottery and crossword puzzles and all that. And then 194N is what is the cash withdrawal. A person can maximum withdraw cash up to 1 crore. If it is beyond that, there is a tax deduction, if I'm not wrong, 2% can be deducted by the banker. That 1 crore limit is increased to 3 crores in the hands of a cooperative society because they deal with the rural population and all that. They are given a bigger threshold. 194R again is the benefit in kind or in cash received by an SSC, which I have discussed 28.4, against which 194 has come into the statute book. There also that benefit or perquisite could be either in cash or in kind, partly in cash, partly in kind. This is a consequential amendment. 196A, it says, this is again a facilitating provision for the non-residents. If at all there is a tax treaty rate which is more favorable than the Finance Act rate, it is duty bound for the assessing officer to follow that. There accordingly, the deductor can go by the treaty rate or the domestic law, whichever is more beneficial, as per the provisions of Circular 333 of 1982. And LRS scheme, this is the table all of us we know. If LRS aggregate amount during 7 lakhs or less, it was nil earlier. Now it is, the rate is 20% for the other category. I will tell you what are that categories. If the aggregate amounts during the financial year are excess of 7 lakhs, it would be 5% earlier, before amendment, 20% in future. Proposed remittance for overseas tour program package, irrespective of there is no limit for them. Earlier it was 5%, now it is 20%. Remittance of the amount being remitted out is a loan from a financial institution for the education purpose, then it is only 0.5% that continues as 0.5% even in future. Then remittance for the purpose of education, if the aggregate amount is in excess of 7 lakhs, that is from own funds, then 5%, that same 5% is maintained. And remittance for purpose of medical treatment also 5% is maintained. Okay, then we are at loss to understand why there is a 20%, 20% slabs are there on the top. That is aggregate if it is excess of, 20% slabs with respect to tour package is 20%. Any other category is also 20%. So tour package or any other category, we can say, we do not have to say, it is 20% LRS is there now. TCS is there. What is LRS? Liberalized remittance scheme up to $2.5 lakh under the FEMA regulations. Now that $2.5 lakh is being used for several purposes by the transferors. They can make investment in foreign securities, which is allowed under the FEMA regulations. They can use it as a gift to his son or daughter who is doing education for the education purpose or medical expenses, anything. So this 2.5 lakhs has become a big issue before the government because so much of amount is being transferred and they would like to keep a track. TCS is always a tracking system and it is not a taxing system. When it is a tracking system, why should you have 20%? It can be 5% also. You can track the same transaction with 5% also. Why it should be 20%? See, in the name of tracking, again, they are trying to hold money, which is always the case. 206 AB and 206 CC, this is the non-filers. See, there is one provision that has come into the statute book 2 years back. If you are deducting taxes in the case of a non-filer, if the payee is a non-filer, you should also go and see his auditor, take his tax file, verify whether he has filed his returns, whether it is possible. You should know that if it is a non-filer, you have to increase the tax deduction rate. And the saving grace is, from that they have removed those SSEs who are not required to file the return. It is not any favor. They have done the right thing, that's all. Non-filers, that means who are not required to file any return as per the law, like non-residents who do not have income, or some non-residents who are not covered here, they get covered by 195. So who are not required to file, there is a exception list that those people are a non-resident who doesn't have a permanent establishment in India are going out of the non-filers radar. And this withholding of refunds, again, they have brought the facilitating provisions his attention. So facilitating provision to the government, your refund cannot come, they can withhold the refund and they need not pay additional interest under 244(1)(a) till the time they do the assessment, because if they do not know whether there would be any tax liability arising from the assessment which is pending. That is one. Number two, they can always adjust the refund against any other demand that is pending. That is now legitimized through the provisions here. And interim board for settlement is a replacement for the settlement commission. In the transition, there is some trouble. There are some orders against which the rectification has to be filed, which could not be filed, and the time got exhausted, which time is now extended up to 30th September 2023. Settlement commission means it is all such cases where you go for a settlement that has been replaced with the interim board of settlement now. And 269 SS&T, that the basic limit has been increased to 2 lakhs in the hands of Agricultural Credit Society, and both for taking loans, taking deposits and giving loans to the members of the society. And 271C and 276B, you please bear it in mind. These are the, we have come to the end of the session, don't worry. And there are 2 slides. 276, 271C and 276B have been brought in, mainly targeting virtual digital asset, that is the cryptocurrencies, and 115BA on 194BA, that is the deduction in respect of online games, and 194R is the perquisite, that is what we have discussed, 28(4), the corresponding 194. If at all there is any default in complying with these provisions, the deductors can be hauled up with special penalty and also the prosecution. And in fact, it is very interesting to know when virtual digital asset, what is still, we do not know, it's at a fluid stage because even the government did not bring any legislation to either ban the cryptocurrency or to allow it as a legal tender. Anyhow, they made it very clear that it is not a legal tender. Pardon, it's not a legal tender. They made it very clear. RBI made it very clear, but they did not ban it. So they allowed transactions to go in. That is the reason everyone was happy that they are legitimizing the entire cryptocurrency industry by bringing a tax on that. So they have readily clarified last year, taxing a transaction doesn't mean that we have legitimized that. Even Pyara Singh's case, Supreme Court said, even if you make illegal income, that is taxable. It doesn't mean that you can do illegal business under the law. You will be punished for that illegal business separately. But the taxation will not stop whether it's a legal business or illegal. S.C. Kothari's case, 83 ATR, 82 ATR, I think, the same proposition has been learned, whether it's legal or illegal, the income is taxed. That's all. In the same way, virtual digital asset transactions, it is not clarified whether it is legitimized or not. In view of that, many companies who are into cryptocurrency have stopped their activity because they don't have a full green signal from the government. And RBI repeatedly tells that it must be banned and threatens everyone, which is not a law yet. That is the position where we stand. But this 30% is taxed without allowing you to adjust the losses. At least online games, they are taking the net winnings. For virtual digital asset, you have a loss, the transaction is different. Each transaction has to be treated separately with a 30% tax. And that 194 ST, I think ST or something is that, which will be administered by the crypto exchange. Because of this amendment, all these youngsters who are into cryptocurrency, they started trading in the global exchanges. For your information, in Europe, Slovenia, cryptocurrency is a legal tender. Many countries, cryptocurrency is a legal tender. What is cryptocurrency? I'm yet to understand. I don't know what it is. So with all my effort, I could not make out what it is. There is one lady chartered accountant in Delhi. Her name is, she's Mehra. She's an expert in blockchain technology. She's often invited as a speaker in the IFA conferences because entire cryptocurrency is based on the blockchain technology that is called multi-ledger technology. And the encryption or the secrecy is maintained at the highest level. And there is no possibility for anyone to tinker with the transactions that are recorded. But with all said and done, best technology is happening. But what is the underlying asset for a cryptocurrency to be valued at $60,000 US, which has come down drastically? The Bitcoin has come down to 29,000. We do not know what is the underlying asset. Today, if you are trading in the Bombay Stock Exchange or the National Stock Exchange, suppose you are trading in the TCS share, you have the assets in the balance sheet on basis of which you have the earnings, the tangible earnings there. We don't have anything. I have asked 2-3 in the recent conference, 20th January, we had the Institute Conference on International Taxation at the Center of Excellence. We have invited Pankaj Jain, who is now, he's ex-KPMG, PwC director. Now he's individual practitioner. He is chairman IFA Hyderabad also. He wrote a small book on cryptocurrency along with one Deepak Jain, who is into indirect taxes. They have given the implications both under the income tax law and indirect tax law. What is cryptocurrency? I have asked Deepak Jain, can you explain what is the underlying asset? He said, no, I can't explain it. Then how it is being traded at that high value? It's all the speculation. US is known for creating speculation markets. And that is where we had the biggest crisis in 2008 in the Goldman Sachs and Lehman Brothers. They have crumbled and they created a global crisis. India is only economy which was so resilient even at that time. India is again resilient today in the global recession. India is a shining star. This is a bright star. That is what they have classified. So it is a heartening news to know about that, because our fundamentals are always strong and we have the conservative approach. So be that as it may, when the youngsters have moved the global exchanges to trade in cryptocurrencies, that news will readily come to the government, and they want all these people to come back and trade here and pay taxes. That is the reason these provisions have come in. If they cannot catch global exchanges and brought to any sort of compliance under 271C or 276B, then what happens? These provisions would be applied against these residents who are doing the transaction in the global exchanges. They would definitely get the exchange of information is very effective in India now because of the exchange of information treaty we have with various countries. So once that information is available, all these youngsters who are into this cryptocurrency will be booked, because that part of the revenue is lost in this country. That is the reason the news is all these youngsters are quickly coming back to Indian exchanges and they are ready to pay the taxes. Then it will not end there. They will say, what happened to the last 1 year account? You bring it. That would be the next question. 271 FAA is this financial transactions which are captured, that SFTs are something you call, no? What is that financial transaction, which is captured by the financial institutions. If you provide false information, banker or the institution would be penalized and 5,000 rupees would be collected. Banker in turn will collect it from you. So that is the reason you are supposed to provide correct information to the institutions. This is, what is this subsection about? Initiated on after the 1st April. Fails to, same thing. This is 2006. And the authority for joint commissioner appeals is the last item in the slides. And again, the DC appeals we used to have 20 years back. Now you are going to have joint commissioner appeals, because the commissioner appeals pendency is piling up like anything. They want to address this issue, and all lower threshold, I mean, lower litigation appeals would be, they would put a threshold and then transfer the smaller appeals to joint commissioner appeals, and we'll have the rules that would be kept in place. And I'm very thankful for all your patience in going through the clause by clause analysis, which is a great, why I do every year is I am the first beneficiary, because I am forced to read what is 1010D and what is not that, because I operate in a different arena, I may not apply my attention on this regularly, but it's a revisit to the basic provisions, and it's a great help to me. I'm the first beneficiary in this. And of course, Hyderabad branch, I always treat it as my sacred duty to come back and report to you what is the clause by clause analysis. And I'm very happy to be here this evening amidst all of you, meeting all my good friends in a physical CPE meeting. Thank you very much.
Thank you, Prasad sir. No, our committee members are busy with governors, so hence I got a message asking me to come and close, and that's why I'm here. And hopefully this is the last time I'm coming and doing this like this. Yeah. It has been every year that the budget starts with finance minister presenting it in the parliament. And then our discussion concludes with Mr. Prasad's class by class session. Because by the time he finishes it, most of us are either fully aware of some of the clauses and are thoroughly confused about some, so that for fully aware, you don't have to read, and thoroughly confused, we don't want to again go and check that.